Hello, buddy. This is Keith Collins, Finance America. Today, I want to talk about debt-to-income ratio. So, debt-to-income ratio is something that we use a lot in lending. It's not necessarily something that the consumer really needs to know about, but they need to understand that it's extremely important to what we do when we're identifying if a customer can qualify. Essentially, the debt-to-income ratio is a percentage of your debt to your income. Okay, so most programs operate off about a 45% debt to income ratio. Some programs like FHA can go to 55 to 60%. And what that means is if we're doing a 60% debt to income ratio, your monthly obligations reported on your credit report and the housing expense, right? Principal, interest, taxes, insurance, any applicable mortgage insurance, HOA dues, right? And then all the payments associated on your credit report, right? Student loans, credit cards, auto loans, personal lines of credit, those kind of things. The monthly payments on those can be no more than 60% of your gross income. So if your gross income is $10,000 a month, right, $10,000 a month, at a 60% debt to income ratio, your monthly obligations, including the housing payment, can be no more than $6,000 in that scenario. Debt to income ratio, again, is not necessarily something that you need to know as a consumer. It is something that's extremely important to us when we're qualifying customers because we do have to operate off a debt to income ratio. I'm Keith Collins, Finance of America. Let me know if you have any questions. Thank you so much for tuning in.